Well, one stock which has had a stellar journey over the last 2 to 3 years, it's been a multi-bagger over the last 2 to 3 years, 4x returns to investors, is Power Finance Corporation. We have with us Ms. Parminder Chopra, who is the Chairman Managing Director at Power Finance Corporation, with us to talk to us about Q4 numbers and what we can expect going forward after this extremely strong journey in terms of stock price performance. So firstly, welcome on board, ma'am. It's good chatting with you. Thank you so much for doing this. First off, I want to try and understand. The street seems a little bit worried with regard to the draft. They are still in draft. I would like to clarify that. But draft regulations with regard to project financing. Talk to us about the impact of that on your book overall.
See, these draft guidelines, we are in the process of examining in detail. And what we understand that the RBI is concerned about, especially the project assets, where the extension in DCCO is being sought, as this may result in the maybe possible performance of the asset. So going by what has been worded in the draft, which says that wherever extension in DCCO is being sought, 5% of the exposure provisioning has to be done. So on that front, if we see that since PFC is primarily into the project financing across the value chain of the power sector, so that is going to have some impact on PFC also. But PFC, being an NBFC, has switched over to Ind AS norms of the accounting. So what is the difference? That it's not going to, even if some additional provisioning as per RBI guidelines has to be done, it has to be done by impairment reserve over and above the ECL. So that is not going to have any impact on the profits of the company.
Sure.
Definitely, it is going to have an impact on the capital adequacy of the company, which I can share with you, and you might have seen as a part of the results that we are maintaining a very healthy capital adequacy of more than 25%, as against the 15%, and Tier 1 capital is above 23%, as against the minimum requirement as per RBI about the 10%. So going forward, we are waiting for the detailed guidelines and would like to examine in detail that what it has going to have an impact for PFC.
Sure, sure. I totally get where you're coming from, ma'am. But if you can help us break this down, we've been told that the impact is on the project finance book, which is not state government backed. First off, I want to confirm that understanding, because it seems the understanding is with the RBI, and this is coming from your own subsidiary REC, just wish to caveat that. But wish to understand whether that is also your understanding, and what part of your book, if that is true, is non-state government backed and therefore will get impacted by this and will impact your capital adequacy.
With regard to state government guaranteed loans not being covered under these guidelines, I think we need to examine it a bit in more detail.
Fair.
So that may not be possible for me to comment upfront.
Sure.
Just to give an idea that out of our total book, 25% is under implementation.
Okay.
On which we understand that these guidelines are applicable for projects under implementation. And of these 25%, 45% is the generation space, where primarily that is the project financing, and it takes a bit longer for the projects to be implemented as the gestation period is long. So there we may see, in case of you talk of thermal, you talk of hydro, we may see some extension in the DCCO. So as a whole, our major part of book is not impacted by these guidelines. This is what is our understanding from the first reading of the draft.
I take your point, and ma'am, I'd like to explain to our viewers, because 4.5 lakh crore odd is your book size, of which 25%, so around 1,10,000 crore odd is your project finance book, of which the thermal component which you're talking about is roughly 50%, which comprises roughly 10 to 12% of your total book. Yeah. So just about 50,000 crore odd, just for your context. So the impact may be quite small versus what the street seems to be looking at. Perfect, understood. Ma'am, I'd like to move on with regard to your margins and profitability. What expansion can we expect in terms of margins? Because your cost of funds will likely come off, spread expansion likely. And how will that percolate onto, or how will that impact your profitability going forward? Do you expect some bit of profit expansion coming from this spread expansion?
In the short term, it could be, but due to the competitive pressures and the requirement of the sector for the cheaper funds or reasonable cost funds, I think we will be maintaining our spread somewhere between 2.5% to 2.75% only.
Understood.
But the profitability, apart from the net interest margin, depends on lot many things.
Correct.
Like the credit cost and again the fluctuation in the foreign exchange, as 20% of our book is already, we have borrowed from the international market.
Sure.
But I'm happy to share with you that 88% of our foreign currency borrowing has already been hedged. So we have already insulated our profitability to a large extent from any foreign exchange fluctuation. So a very small portion is open. I think that makes sense to keep it open.
I understand. I understand. So two key levers, therefore, that you spoke of, and I'd like to add one more lever to that. So credit costs is one. The other one is loan growth. So let me focus on that first. 12 to 15% loan growth expected going forward. That's what you have guided for in the past. You expect probably a possible upside given the kind of tailwind that the power sector is in. Would you therefore be more bullish in terms of loan growth going forward?
See, what we want to achieve is the sustainable loan growth, and we want to be very prudent in our lending. So it's not that there is no opportunity, there is lot of opportunity, but we pick and choose for funding what is right for the company. So that is how we have been giving the loan guidance somewhere between 12 to 15%.
Understood. And ma'am, on recoveries, you've done recoveries in FY23, I'm talking full year. FY24 also, you have a negative impairment number on your P&L. What's the FY25 expectation? One, in terms of gross recovery, you have around 16,000 crore worth of books in stress which are under resolution. And therefore, how much of that is expected FY25, maybe FY26 also, broadly? And what's the kind of impairment number? Will it continue to remain negative in terms of net?
See, if you see in the current year, we have resolved one account, but in the coming year, two accounts are in the advanced stage of resolution. One is the Lenco Amarkantak and the other one is the Shiga Energy. For Lenco Amarkantak, we are pursuing under NCLT, and the other one, we are doing it outside NCLT. So which we are expecting in the, probably not in this quarter, it will be resolved in the next quarter. There you may see some reversals in the provisioning. We are maintaining on the stage 3 assets, in line with the previous year, we are maintaining 74% coverage. And with Lenco, we are expecting that around 260 crore reversals are expected during the current financial year, in line with the resolution plan submitted in the NCLT, if it is approved as it is. And we are expecting reversals in Shiga also. Additional credit, I agree that credit cost could be something, whatever disbursements we additionally do, on that we have to do the additional credit cost increment.
Correct.
So that in any case is going to...
Will be basis ECL norms.
Yeah, that will be basis
loss
ECL
norms.
norms.
I understand, ma'am. And broadly, what's the credit cost number like on a normalized basis? Because of course we've seen 2-3 years where credit costs have been benign, right? So as they start normalizing, what would that number be? Because that would impact profitability as well.
So we are expecting it is going to remain less than 1%.
I understand. I understand. And ma'am, first off, many congratulations with regard to profitability. Almost 25,000 crore. Not seen too many NBFCs do that. In fact, no NBFC has actually done that. So talk us through where it goes from here. Because you have subsidiaries also which contribute, which are also doing fairly well. So where does the PFC both on a standalone basis and on a consolidated basis? 14,000 odd crore on standalone, 25,000 almost on consol. Where does it go from here?
See, we have been growing our profit in the range of somewhere between 17, 18 to maybe 23, 24% this year you have seen. So we are expecting this to maintain, but that will all depend on the credit cost, additional compliances which we require to make, and definitely the foreign currency portfolio also.
Sure. Okay, so so excellent. Those are some of the caveats on profitability. But thank you so much, ma'am, for speaking with us. It's been good understanding and breaking some of these numbers down with you, real time. And you know, of course, you heard it. Not too much of an impact with regard to the project finance draft guidelines, even if they were to become final as is. Of course, our earlier broad understanding that there was a possibility that state government backed loans may not be covered. Currently not very clear on it, non-committal from the chairman and managing director. But of course, going forward, profitability expected to continue to remain robust and credit cost will start to normalize starting next year.